So this is part 2 of my Grab stock analysis, and in today's video, I'll be talking about Grab's profitability, financial health, outlook, valuation, and risks. In part 1, I already talked about what Grab does as a company, its competitive modes, and its growth profile. So if you haven't done so, I encourage you to watch part 1 as it provides the proper context for today's video. As always, you can read the article version of this analysis, which I will leave the link in the description box below. And with that being said, let's move on with part 2 of the analysis. So looking at the company's profitability, Grab generated gross profits of $860 million in 2023, which represents a 4.1% margin, while in Q4, gross profit was $276 million, which represents a 5.1% margin. And keep in mind that I'll be analyzing Grab's profit margins as a percentage of GMV as opposed to the traditional way of calculating margins, which uses revenue as the denominator. And the reason why I look at profit margins as a percentage of GMV instead of revenue is because revenue is quite volatile, given that revenue is largely affected by total incentives paid out to its consumers, merchants, and drivers. So, by looking at margins as a percentage of GMV, we can see how the company's profitability or margins are really trending over the last few quarters and years. So, if you want to learn more about Grab's business model and how the company recognizes revenue, I encourage you to watch part 1 of my Grab stock analysis, which I will leave the link in the description box below. That said, we can see that gross margins have been improving over the last few quarters. A few years ago, you can see that gross profit was negative, and this is due to the company paying out loads of incentives to consumers and partners. However, the company has reduced total incentives paid out over the last few quarters, which is why gross profit turned positive. And you can also see that gross margin has been trending upwards recently, showing economies of scale within the business, which is what we want to see. Jumping straight to the bottom line, 2023 net income or loss for that matter was negative 486 million, which is negative 2.3% of GMV. As you can see, Grab has pretty much operated at huge losses since inception, which was one of the major reasons why I avoided the company. A couple of years ago, I just didn't believe that Grab has a business model that could turn profitable and sustain that profitability for a long period of time. However, in Q4, Grab turned profitable for the first time ever, producing $11 million of net income at a 0.2% margin, which improved 800 basis points year over year. This was due to lower incentives paid out, which boosted revenue and gross profits. And the company also underwent some restructuring last year, which lowered total operating expenses by about 5% year over year, thus leading to profitability. Whatever it is, I think this changes the whole narrative about the company. No longer is Grab this loss making growth company, but it is now a profitable growth company as well as a cash cow in the making. And judging by how margins are trending, I think profitability will only improve from here. So here we can see how adjusted EBITDA is trending, and keep in mind that Grab reports two types of adjusted EBITDA. First, we have segment adjusted EBITDA, which is basically adjusted EBITDA from each segment excluding regional corporate costs, which are costs that are not classified under any segment. So as you can see, total segment adjusted EBITDA has been improving over the last few quarters. As of Q4, segment adjusted EBITDA was 228 million, which is 4.2% of GMV, up 200 basis points year over year. So as a whole, Grab's different segments are gaining operating leverage. So if we take segment adjusted EBITDA minus regional corporate costs, we get Grab's adjusted EBITDA, which as of Q4 was $35 million, representing an adjusted EBITDA margin of 0.6%. And as you can see, margins have been improving as well, showing operating leverage within the entire business. And this is partially due to lower regional corporate costs as the company began layoffs in June last year. So overall, the company's profitability is getting better and better, but let's take a look at how each segment is performing to get a better understanding of where each segment is heading. So here we have adjusted EBITDA broken down by segment. For the delivery segment, segment adjusted EBITDA was $96 million. Dollars. As a percentage of GMV, Q4 adjusted EBITDA margin for the segment was 3.6%, up 160 basis points year over year and 20 basis points quarter over quarter. So deliveries margins continue to improve due to incentive optimization, operating leverage, and GMV growth. In addition, management also expects deliveries margin to expand by another 100 to 200 basis points in the near future, which is great to hear. As for the mobility segment, Q4 adjusted EBITDA was 182 million. As a percentage of GMV, mobility adjusted EBITDA margin was 12.3% in Q4, down 90 basis points year over year and 50 basis points quarter over quarter. But despite the margin pressure, notice how much more profitable the mobility segment is compared to the delivery segment. And a reason for this is that Grab faces little competition in the ride hailing space. So for the delivery segment, Grab faces a lot of competition from Gojek, Foodpanda, Shopee Food, and more, which is why margins are quite low for the delivery segment at just 3.6%. On the other hand, in most Southeast Asian countries, Grab is virtually a monopoly in the ride hailing market. The only other real competitor to Grab's mobility segment is Gojek in Indonesia, where they still operate a duopoly. So, with less competition in the mobility space, Grab is able to maintain high pricing power, which leads to higher margins for the segment. And given Grab's competitive moats in the mobility space, I think mobility margins should, at the very least, remain stable moving forward. Turning to the next segment, financial services adjusted EBITDA was negative $81 million. Dollars. As a percentage of GMV, adjusted EBITDA was negative 2% of GMV, up 50 basis points year over year, but down 30 basis points quarter over quarter. And if you haven't noticed, the financial services segment is actually the only segment that is not yet profitable. And that is due to the fact that fintech is still in its early stages in Southeast Asia. And given the massive opportunity in the fintech market down the road, it's no surprise why Grab is still investing a ton of money in the space, thus the losses that we see in the segment. And do note that while margins improve year over year, margins actually drop quarter over quarter due to the launch of GX Bank in Malaysia in November last year. But moving forward, I expect financial services margins to expand as more consumers adopt Grab's mobile wallet and digital banking solutions over time. Lastly, we have the enterprise segment, which recorded an adjusted EBITDA of $31 million dollars in Q4. As a percentage of GMV, adjusted EBITDA was 49.1%, which is way higher than the other three segments as you can see right here. So margins actually improved by about 35 percentage points year over year and 8 percentage points quarter over quarter, showing very strong operating leverage, mainly due to the increase in revenue. And given its strong growth and profitability profile, I believe the enterprise segment could one day be a major cash cow for Grab. And at the same time, I expect margins to continue to expand to as high as 50% plus. So, very excited for what the future holds for this segment. All in all, I'm very impressed with how Grab's profitability is trending so far. The company has pretty much operated at massive losses ever since it was established due to heavy investments to acquire new users, expand geographically, and launch new products. However, that narrative has completely changed as the company turned profitable for the first time ever in Q4. And this just goes to show that Grab has a viable and sustainable business model, which is something that I can't confidently claim a year or 2 years ago. As we've seen, Grab's profitability are all trending in the right direction, showing strong operating leverage, which should also strengthen its cost advantage and efficient scale modes, leading to an even stronger competitive positioning. But all things considered, I think this is just the beginning of Grab's profitability journey. Along with improving profitability, Grab also has a fortress balance sheet. As of Q4, Grab has about $5 billion dollars of cash and short term investments, which increased $245 million quarter over quarter. Total debt stands at about $793 million, placing its net cash position at about $4.25 billion, dollars, which increased $230 million dollars quarter over quarter. To give you some perspective, net cash of $4.25 billion dollars is about 35% of its current market cap of $12.3 billion, which is insanely high. That said, we can see that net cash has been declining, but that's understandable given that the company is still in investment mode. However, net cash balance should grow over the next few quarters as profitability and cash flows continue to improve. Speaking of which, Grab is still cash flow negative on an annual basis, with a free cash flow of negative $54 million dollars in 2023. This includes $184 million dollars of loans receivables and $364 million dollars of customer deposits. So, adjusting for these items, we have an adjusted free cash flow of negative $234 million dollars in 2023, which, although is still negative, it is a decent improvement from 2022's adjusted free cash flow of negative $825 million. And this was mainly driven by higher cash flow from operations, which turned positive in 2023 at about $86 million dollars compared to negative $798 million in 2022. With that being said, I expect Grab to turn adjusted free cash flow positive in 2024 and beyond, since the company is now focusing on driving profitable growth. And besides, the company is already adjusted free cash flow positive in Q4. Nevertheless, with its robust balance sheet position, the company authorized its first ever share repurchase program of up to $500 million. dollars. And in addition, the company also announced the repayment of term loan debt facility, which is expected to reduce annual interest expenses by $50 million, dollars, thus further improving profitability and free cash flows. I think the buyback program and repayment of its term loan just shows how confident management is in terms of the financial health of the company, as well as how attractive the valuation of the company is at current prices. And before we talk about valuation, let's quickly talk about the company's outlook. So here I have a table of management's full year 2024 guidance, its actual 2023 results for comparison, as well as analyst estimates for 2024. As you can see, management expects 2024 revenue to be in the range of 2.7 billion to 2.75 billion, which implies a year-over-year growth rate of 14% to 17%, which unfortunately is a significant slowdown from 2023's growth of 65% year over year. And this also fell short of analyst estimates of $2.82 billion. dollars. So, considering the steep deceleration in revenue growth and miss on analyst estimates, it's understandable why the stock sold off following Q4 earnings. On the bright side, management expects 2024 adjusted EBITDA of 180 million to 200 million, which is a significant improvement from last year's figure of negative $22 million. In other words, expect profitability to continue to improve from here. During the earnings call, Grab CFO also gave out more details about the company's outlook. In terms of on-demand GMV, the company expects Q1 on-demand GMV to be stable on a quarter-over-quarter basis, which implies a 16% year-over-year growth in on-demand GMV in Q1. In addition, management expects to see a sequential rebound of GMV in the second quarter and continued growth during the year. So put differently, expect strong on-demand GMV growth throughout 2024, which is great to hear. As it relates to on-demand margins, management expects mobility margins to be maintained at around 12% plus and deliveries margins to be 3% plus through 2024. For context, Q4 mobility margins was 12.3% and Q4 deliveries margins was 3.6%. So based on management's remarks, we won't see much improvement in on-demand margins in 2024, which is quite a disappointment. On a more positive note, beyond 2024, they expect margins to expand by a further 100 basis points to 200 basis points for the delivery segment as the company build out new products and features that will enhance its operational efficiencies as well as drive greater marketplace optimization. So beyond 2024, things will look much better from a profitability standpoint. Moving on, for the financial services segment, management expects losses to sequentially narrow heading into 2024, coming down from peak losses in the fourth quarter of 2023. So, put simply, expect financial services margins to improve moving forward. Next, management also expects adjusted free cash flow for 2024 to improve substantially year over year as the company continues to grow profitability and drive cash flow generation. So that's another great news for investors. Management also gave their revenue outlook beyond 2024, and as I've discussed earlier, the revenue outlook for 2023 was pretty underwhelming. However, management anticipates revenue growth beyond 2024 to accelerate as they are incubating and scaling up a series of tech led products and initiatives, including digital banks, advertising, and high value offerings. In short, I think management gave out really strong guidance. Everything from GMV growth, profitability, and cash flows are expected to remain robust. Everything looks great except for revenue growth. But that's okay because management expects revenue to reaccelerate in 2025 and beyond, which sounds really exciting to me. Whatever it is, I believe Grab still has a long growth runway ahead due to the ongoing digital transformation in Southeast Asia. According to a research report by Bain, Temasek, and Google, food delivery GMV in Southeast Asia is expected to grow at a 12% compounded annual growth rate in 2024 and 2025, which should boost Grab's delivery segment. And the same goes for mobility segment, with mobility GMV in Southeast Asia expected to increase at a CAGR of 18% over the next 2 years. Online media GMV in Southeast Asia is also expected to grow rapidly. In particular, digital advertising is expected to grow the fastest at a CAGR of 15% over the next 2 years, which should drive growth for Grab's advertising business. And last but not least, we have the fintech industry. And I think this is the most exciting growth opportunity for Grab as fintech adoption is still very early in Southeast Asia, with the majority of the population in the region being either underbanked or unbanked. As you can see, digital payments, lending, insurance, and wealth are all expected to skyrocket in the next few years. And as you know, Grab offers digital payments, lending, and insurance services currently. So Grab's financial services segment will enjoy massive tailwinds from this secular growth trend. And given Grab's massive scale and network, I think Grab will be a winner in the fintech space as it can distribute its financial products more effectively and efficiently than virtually any player in the market. That being said, Grab's growth story depends on the overall growth of the digital economy in Southeast Asia. As you can see, the digital economy in each of the major countries in Southeast Asia is set to expand and expand and expand over the next few years. And given Grab's leadership position in multiple categories, I believe the super app still has a massive growth runway ahead as it capitalizes on this market opportunity. So in short, I think the future is really bright for Grab. Let's now look at valuation, which is probably one of the most important things to consider when buying a stock. It doesn't really matter if the company has strong growth or moats or margins. At the end of the day, you want to avoid overpaying for any particular stock. But in Grab's case, I think valuation is especially attractive at current prices. As you can see, Grab currently trades at an EV to revenue multiple of just 3.4 times, which is extremely cheap compared to its peak multiple of 32 times and average multiple of 7.4 times. So relative to its historical multiples, I think Grab is very undervalued here. Here we have revenue multiples of some of Grab's peers. As you can see, DoorDash trades at a multiple of 5.9 times, Uber at 4.4 times, Instacart at 2.6 times, and Lyft at 1.6 times. So just by looking at this chart, we can see that Grab, which is the purple line right here, is trading cheaper than DoorDash and Uber. And this is probably because US stocks get a premium over Asian stocks. On the other hand, Grab trades more expensively compared to Instacart and Lyft, and I think this is due to Instacart and Lyft being quote unquote lower quality businesses than industry leaders DoorDash and Uber. And so I think the lower multiples are justified. Whatever it is, notice that all of Grab's peers have enjoyed valuation multiple expansion over the last 6 months, whereas Grab's multiples have been going lower and lower over the same time frame. So I think Grab's multiple will eventually reverse and expand just like its peers, which should provide meaningful upside for investors. All things considered, I think Grab should be trading at higher valuations compared to peers. I think Grab deserves a much higher multiple considering that Grab is essentially Uber, DoorDash, and PayPal combined together. And I think analysts and institutions agree with me. As you can see, analysts have an average price target of $4.65 for Grab stock, which represents an upside potential of 48%. As of this video, there are 21 strong buy and 6 buy recommendations with 0 sell ratings, as you can see right here. So it's safe to say that analysts are incredibly bullish on the stock. In addition, institutions have also been adding to Grab stock in recent months. I think the company turning profitable in Q4 plays a huge factor into the recent institutional buying, and I expect this to continue over the next few quarters as the fundamentals of the business continue to improve. As for me, I have a base case price target of $6.47 based on very conservative assumptions. I won't go through all my assumptions in this video, but if you want all the details on how I arrive at these price targets, you can check out my article which you can find in the description box below. That said, I expect Grab to grow GMV by 9% every year through 2033, with the company reaching nearly $50 billion of GMV by 2033. Next, I expect cash flow margins to be about 5.3% by 2033. As a reminder, Grab is already adjusted free cash flow break even in Q4, and I expect the company to continue to gain operating leverage over the next decade. And based on a perpetual growth rate of 2.5% and a discount rate of 10%, I arrive at an intrinsic value per share of $6.47 for Grab stock, which represents an upside potential of more than 100% based on the current price of $3.14. I've also included my bear and bull cases, which offers an upside potential of 42% and 180% respectively. But just to summarize, I believe Grab stock is significantly undervalued. Quickly going through the risks, I think the biggest bear thesis against Grab is that competition is really tough in Southeast Asia. As you can see, here are some of the major competitors in each of Grab's operating segments. In the food delivery space, Grab faces competition with Gojek, Foodpanda, Shopee Food, and Deliveroo, and more. Other large food delivery companies outside of Southeast Asia may also enter the region, putting more pressure on Grab. This includes San Francisco's DoorDash and India's Zomato. In the mobility space, Grab's main competitor is Gojek, such that Grab and Gojek hold a duopoly in the ride-hailing business in Indonesia. There are other smaller players like InDrive, Bolt, and Maxim, but other than that, I wouldn't worry too much about competition in the mobility space since Grab operates a virtual monopoly in other Southeast Asian countries. However, we can't ignore the possibility of other international players entering the Southeast Asia market, including India's Ola Cabs and China's Didi Global. In addition, Shopee is already in the food delivery business, and although unlikely, there's a chance that they might get into the ride hailing business given that food delivery and ride hailing are very similar business models. But I don't think Shopee will do that since it will likely be a losing game for Shopee. In the fintech space, Grab is also dealing with strong opposition, including GoPay, which is owned by Gojek, C Money, which is owned by C Limited, which owns Shopee, and also there's Dana and LinePay and so on. That being said, all this competition may lead to a price war, forcing Grab to deploy more incentives to maintain market share. In addition, the services that Grab offers have the risk of being commoditized, which could mean lower profit margins and cash flows for the company. However, I believe competition is more of a temporary issue than a permanent problem. Competition may be able to undercut Grab for a while, but I don't think they have the capital resources to do so for a long period of time. In addition, competition, especially the smaller, newer players, are likely to lose to Grab given Grab's competitive advantages in terms of cost structure, efficient scale, and network effects. Competition is a risk, but it's definitely not a thesis breaker. In a nutshell, Grab is the leading super app in Southeast Asia with strong brand, high switching costs, powerful network effects, low cost advantage, and efficient scale modes. Because of these modes, I believe Grab will continue to experience strong growth over the next decade, especially given the massive tailwinds from the ongoing digital transformation in Southeast Asia. The company is also showing strong operating leverage, with profitability getting better with each passing quarter, which should accelerate earnings growth for years to come. But despite being a fundamentally stronger company today than it has ever been, the stock is still down 80% from its all time highs, which offers a great buying opportunity for investors today. I think there's a big disconnect between fundamentals and the stock price, and I think the stock price will eventually catch up with the fundamentals. And with all this in mind, I have started a position in Grab stock. With that being said, thank you guys so much for watching part 2 of my Grab stock analysis. If you haven't done so, you can watch part 1 right here. If you enjoyed this video, please leave a like, comment, and subscribe to my channel as it really supports the channel. As always, thank you guys so much for watching this video, and I'll see you guys on the next one.